What if you could peek inside the portfolios of billionaires? What if you could see exactly where the ultra-wealthy park their money and why their investment strategies look completely different from what financial advisors tell average investors? Today, we're unlocking those secrets. This is Invest Like a Billionaire by Bob Fraser Ben Fraser, two professionals who've spent years studying the investment patterns of the wealthiest people on the planet. And what they discovered might shock you. The ultra-rich don't invest the way you've been taught. They don't follow the traditional 60-40 stock and bond allocation. They don't put their faith in mutual funds and hope for 7% annual returns. Instead, billionaires use alternative investments that most people have never heard of. They access deals that aren't available to the general public. They think about risk, returns, and wealth preservation in fundamentally different ways. And the gap between how billionaires invest and how everyone else invests explains much of the wealth inequality we see today. The good news? You don't need billions to start investing like a billionaire. Many of these strategies are accessible to anyone willing to educate themselves and think differently. By the end of this video, you'll understand the investment framework that built some of the greatest fortunes in history. You'll see why billionaires avoid what Wall Street pushes on retail investors. And most importantly, you'll learn practical steps to start implementing these strategies in your own portfolio. Let's dive into the wealth secrets of the ultra-rich. The Billionaire Portfolio Breakdown. The Frasers start by revealing something most people never realize. Billionaire portfolios look nothing like yours. When researchers analyzed the asset allocation of the ultra-wealthy, they found a stunning pattern. While average investors have 70 to 90% of their wealth in stocks and bonds, billionaires typically have only 20 to 30% in public equities. So, where's the rest? It's in alternative investments. Private equity, private real estate, private credit, hedge funds, commodities, collectibles, and direct business ownership. These alternatives make up the majority of billionaire wealth, often 60 to 80% of their portfolios. Why does this matter? Because alternative investments behave differently than stocks and bonds. They're not subject to the same market volatility. They often produce higher returns with less correlation to public markets. They provide tax advantages that public securities can't match. And they offer control and influence that passive stock ownership never provides. The Frasers explain that this allocation isn't accidental. Billionaires aren't avoiding stocks because they're stubborn or uninformed. They're making calculated decisions based on access to better opportunities. When you have significant capital and the right connections, you can invest directly in businesses before they go public. You can buy entire real estate portfolios. You can fund private credit deals with double-digit returns. Why would you settle for whatever the public market offers when you can access superior alternatives? But here's the critical insight. This isn't just about having billions. The principles behind billionaire allocation apply at every wealth level. Even with $50,000 or $100,000, you can start shifting away from public market dependence toward alternatives that offer better risk-adjusted returns. The traditional advice to put everything in index funds serves the financial services industry more than it serves you. It's easy to sell, easy to manage, and generate steady fees, but it's not how wealth is built at the highest levels. The Frasers argue that if you want billionaire-level results, You need to start thinking about allocation like a billionaire, not like a retail investor following generic advice. The practical lesson: examine your current portfolio allocation. How much is in public stocks and bonds? How much is in alternatives? If you're like most people, you're dangerously overweighted in public markets. Start researching alternative investments available at your wealth level. Educate yourself on private real estate syndications, private equity funds accepting accredited investors, or even alternative investments you can control directly, like starting a business or buying rental properties. The goal isn't to abandon stocks entirely, but to build a more resilient, diversified portfolio that mirrors how the wealthy actually invest. Alternative investments, explained, the Frasers dedicate significant attention to demystifying alternative investments. For most people, alternatives sound complicated, risky, or inaccessible, but understanding them is essential because they're the wealth-building engines of the ultra-rich. Let's break down the major categories. Private equity involves investing in private companies, either directly or through funds. Unlike buying public stock, you're often getting in at earlier stages with more upside potential. Private equity returns have historically outperformed public equities significantly, though with less liquidity and higher minimums. Private real estate goes beyond buying a rental house. It includes commercial properties, multifamily apartment complexes, self-storage facilities, industrial warehouses, and more. Billionaires love real estate for its cash flow, appreciation potential, tax advantages through depreciation, and inflation hedging characteristics. The Frasers emphasize that private real estate syndications now allow smaller investors to participate in large commercial deals that were once exclusive to the ultra-wealthy. Private credit means lending money directly to businesses or projects in exchange for interest payments. With banks tightening lending standards, private credit has exploded. Returns often range from 8 to 15% annually, higher than bonds with comparable risk profiles. Billionaires have allocated heavily into private credit over the past decade. Hedge funds use sophisticated strategies like long-short equity, merger arbitrage, and global macro trading to generate returns independent of market direction. While traditional hedge funds require massive minimums, the strategies are increasingly accessible through alternative platforms. Commodities, including gold, oil, agricultural products, and other physical assets, provide inflation protection and portfolio diversification. Collectibles like art, wine, classic cars, and even NFTs represent another alternative category some billionaires use. The key characteristic linking all alternatives: they're not traded on public exchanges. This means less volatility, less daily price transparency, and typically longer holding periods. For most investors accustomed to checking stock prices daily, this feels uncomfortable. But the Frasers argue this illiquidity is actually a feature, not a bug. It removes the temptation to panic sell during downturns. It forces long-term thinking, and it allows investments to compound without the interference of emotional decision-making. The practical application: you don't need millions to start with alternatives. Begin by educating yourself. Read about private real estate syndications and find reputable sponsors. Research private equity funds that accept accredited investors. Or if you don't qualify yet, look at interval funds and tender offer funds that provide alternative exposure with lower minimums. Consider peer-to-peer lending or private credit platforms. Explore real estate crowdfunding. Start small with a percentage of your portfolio and learn as you go. The goal is to gradually build alternative allocation as your knowledge and capital grow. Alternatives aren't all or nothing. They're a spectrum of opportunities to diversify beyond the public markets that dominate retail portfolios. The power of direct ownership. One of the most powerful concepts the Frasers explore is direct ownership. Billionaires don't just invest in businesses, they own businesses. They don't just invest in real estate, they own properties. This distinction is critical to understanding how massive wealth is built. When you buy stock, you own a tiny piece of a company with no control, no influence, and no ability to impact outcomes. You're completely passive. Your returns depend entirely on management decisions you can't affect and market sentiment you can't control. When you own a business directly, everything changes. You make the decisions. You control operations. You determine strategy. You directly impact the outcome. The Frasers illustrate this with examples. Warren Buffett didn't become a billionaire just by buying stocks. He bought entire companies through Berkshire Hathaway and actively influenced their management. Real estate billionaires don't just own REIT shares. They own massive property portfolios they actively manage and improve. The wealth isn't just in owning assets, it's in controlling them. Direct ownership provides benefits beyond just returns. It offers tax advantages through deductions and depreciation. It creates equity that can be borrowed against. It generates cash flow that's predictable and controllable. And it builds something with transferable value, an asset you can sell when you're ready to exit. The practical lesson here is profound. At some point, you need to transition from investor to owner. If you're employed, consider starting a side business with ownership potential. If you're already a business owner, think about how to scale and build equity value. If you're interested in real estate, consider buying rentals directly rather than just investing in REITs. Direct ownership requires more effort and carries more responsibility, but it's where exponential wealth is created. Billionaires understand that true wealth comes from building and owning assets, not just holding diversified portfolios of securities. You might not buy entire companies tomorrow, but you can start small with direct ownership opportunities that give you control and hands-on involvement in wealth creation. Tax efficiency and wealth preservation. The Frasers reveal something that shocks most people. Billionaires often pay lower effective tax rates than middle-class workers. This isn't because of cheating or illegal schemes. It's because they understand tax law and structure their wealth to take advantage of every legal benefit available. The tax code is fundamentally designed to incentivize certain behaviors: business ownership, real estate investment, energy production, and job creation. When you align your wealth-building strategy with these incentives, your tax burden drops dramatically while you build wealth faster. Let's start with capital gains. When billionaires sell investments, they typically pay long-term capital gains rates of 15 or 20%, far below ordinary income tax rates that can exceed 40%. But they go further. They use strategies like tax loss harvesting to offset gains with losses. They donate appreciated assets to charity and deduct full market value while avoiding capital gains entirely. They use opportunity zones to defer and reduce taxes on reinvested gains. Real estate offers even more powerful tax benefits. Depreciation allows you to deduct the theoretical wear and tear on property against your income, even while the property appreciates in value. This creates paper losses that shelter real income. Cost segregation accelerates these deductions into early years. The 1031 exchange allows you to sell properties and reinvest proceeds into new properties while deferring all capital gains taxes indefinitely. Some billionaire real estate investors go decades without paying capital gains by continually exchanging properties. Business ownership provides massive tax advantages. Business expenses are deductible before taxes, unlike personal expenses paid with after-tax dollars. Retirement plan contributions for business owners can be many times larger than employee limits. Qualified business income deduction provides an additional 20% deduction for many business owners. And when you eventually sell a business, much of the gain can be taxed at favorable capital gains rates rather than ordinary income rates. The Frasers emphasize estate planning as crucial for wealth preservation. Billionaires use trusts, family limited partnerships, and gifting strategies to transfer wealth to heirs with minimal estate tax. They use life insurance to provide tax-free income to beneficiaries and liquidity to pay estate taxes without liquidating assets. They establish private foundations to create charitable legacies while securing tax deductions. Asset protection goes hand in hand with tax efficiency. Billionaires structure their holdings through LLCs, limited partnerships, and trusts that protect personal assets from business liabilities and lawsuits. They maintain significant umbrella insurance policies. They keep different business ventures and property holdings in separate entities so that problems in one don't affect others. The practical strategy: stop thinking of taxes as unavoidable and start seeing them as manageable through proper planning. If you're a W-2 employee, you have limited tax options, which is exactly why transitioning to business ownership or investment income is so powerful. Work with a qualified tax strategist, not just a preparer who files forms. Look for ways to convert ordinary income into capital gains. Use retirement accounts to their maximum potential. If you own real estate, ensure you're capturing all available depreciation benefits. Structure business entities properly for liability protection and tax efficiency. Make charitable giving strategic, not random. The wealthy don't pay more taxes than required by law, and neither should you. Every dollar saved in taxes is a dollar available to invest in wealth-building assets. Over a lifetime, tax strategy can mean the difference between moderate wealth and generational wealth. Risk management like the ultra-rich. The Frasers tackle a common misconception. People assume billionaires are huge risk-takers. The truth is more nuanced. Billionaires take calculated risks where they have edge, knowledge, or control. But they're extremely risk-averse in other areas. They don't gamble with their wealth. They manage risk obsessively. First, billionaires diversify differently than average investors. Traditional advice says diversify across many stocks within public markets. Billionaires diversify across asset classes, geographies, industries, and investment structures. They don't put all their wealth in one country's economy or one sector. They spread across private equity, real estate, businesses, commodities, and, yes, some public securities. This true diversification provides resilience against any single economic shock. Second, billionaires focus on asymmetric risk-reward opportunities. They look for investments where the potential upside dramatically outweighs the downside risk. A venture capital investment in an early-stage company might risk losing 100%, but the potential upside could be 50 times or 100 times the investment. The math works because you only need one or two huge winners to more than offset the losses. Average investors rarely get access to these asymmetric opportunities because they stick to public markets where information is widely known and pricing is efficient. Third, billionaires maintain liquidity. Despite having most wealth in illiquid alternatives, they keep cash reserves for opportunities and emergencies. When markets crash, they have dry powder to buy assets at depressed prices. They never face forced liquidation at the worst possible time. This liquidity management is a competitive advantage most people overlook. Fourth, they use insurance strategically. Life insurance, disability insurance, key person insurance for businesses, umbrella liability policies. These aren't expenses to minimize. They're risk transfers that protect wealth from catastrophic loss. The practical lesson: stop confusing risk-taking with recklessness. Take concentrated risks in areas where you have expertise, but diversify away risks you can't control. Build an emergency fund so you never have to liquidate investments at bad times. Use insurance to transfer risks that could be financially devastating. Look for asymmetric opportunities where the upside potential far exceeds the downside risk. Study investments thoroughly before committing capital, and understand that the biggest risk often isn't taking action, but staying too conservative and letting inflation erode your purchasing power. Billionaires aren't gamblers. They're calculated risk managers who protect their downside while maximizing upside potential. The importance of financial education. The Frasers emphasize something that might seem obvious, but is often ignored. Billionaires are financially educated. They understand money, markets, investments, taxes, law, and business at deep levels. This knowledge is their greatest asset, more valuable than any single investment. Most people spend more time choosing a Netflix show than educating themselves about investing. They delegate financial decisions to advisors without understanding the recommendations. They follow generic advice without questioning whether it serves their interests. The ultra-rich take the opposite approach. They study relentlessly. They read voraciously. They surround themselves with experts, but always maintain enough knowledge to ask intelligent questions and make informed decisions. Financial education isn't about memorizing formulas or becoming a CPA. It's about understanding principles. How does money work? How are wealth and value created? What drives investment returns? How do taxes impact wealth building? What risks exist, and how can they be managed? How do successful people structure their finances? These fundamental questions shape decision-making. The Frasers note that billionaires often have teams of advisors, CPAs, attorneys, investment managers, insurance specialists, estate planners. But they don't blindly follow advice. They understand enough to evaluate recommendations, spot conflicts of interest, and make final decisions themselves. They're the CEOs of their own wealth. Education also provides the confidence to pursue non-traditional opportunities. When you understand private equity, you're comfortable evaluating deals. When you understand real estate valuation, you can spot good properties. When you understand business fundamentals, you can assess whether a company is worth investing in or starting. Lack of education keeps people in their comfort zone, which for most means staying in traditional investments with limited upside. The Frasers also discuss the importance of learning from failures. Billionaires who've lost fortunes and rebuilt them share that the failures taught more than the successes. Financial education isn't just book learning, it's experiential. You need to take action, make mistakes, learn, and adjust. The key is making smaller mistakes early in your journey so you're prepared to handle larger sums later. The practical application: commit to ongoing financial education. Read books about investing, business, and wealth building. Listen to podcasts featuring successful investors and entrepreneurs. Take courses on topics like real estate investing, business valuation, or tax strategy. Join investment clubs or mastermind groups where you can learn from peers. Attend conferences and seminars. Follow blogs and newsletters from experts. Most importantly, start small with real investments where you have skin in the game. Nothing accelerates learning like having your own capital at risk. The wealthy never stop learning about money. They know that knowledge is the one asset that can't be taxed, inflated away, or confiscated. Invest in your financial education as aggressively as you invest in financial assets, and watch how quickly your wealth building accelerates. Building your wealth team. A key insight from the Frasers is that billionaires don't build wealth alone. They assemble teams of specialists who provide expertise, connections, and support. The lone wolf approach might work for accumulating your first 100,000, but building serious wealth requires collaboration and delegation. Your wealth team typically includes several key players: a financial advisor who understands your goals and helps coordinate strategy, though the Frasers warn to choose carefully since many advisors are really salespeople for financial products. A CPA or tax strategist who proactively looks for tax savings, not just someone who files returns. An attorney who handles entity structuring, contracts, and estate planning. An insurance specialist who ensures proper coverage without over-insuring. And depending on your situation, specialists like real estate brokers, business consultants, investment bankers, or private equity advisors. The Frasers emphasize that your team should work for you, not the other way around. Many people feel intimidated by professionals and hesitate to ask questions or push back. Billionaires do the opposite. They interview multiple candidates, negotiate fees, set clear expectations, and fire underperformers. They understand these are vendor relationships, not positions of authority. Quality matters more than quantity. One great tax strategist who saves you $100,000 annually is worth more than 3 mediocre accountants. One attorney who structures your entities properly from the beginning saves you from costly mistakes later. Don't cheap out on professional advice in areas critical to wealth building. False economy is expensive, but the Frasers also warn against over-delegation. Some wealthy individuals become completely dependent on advisors and lose touch with their own finances. The goal is informed delegation, not abdication. You should understand your financial situation well enough that no single advisor could take advantage of you or make decisions you don't comprehend. Building your team also includes peer relationships. Mastermind groups, investment clubs, and networking with other wealth builders provide invaluable insights, deal flow, and accountability. The Frasers note that many billionaire deals happen through personal networks, not public marketplaces. Who you know directly impacts what opportunities you access. The practical strategy. Assess your current team. Do you have the right professionals supporting your wealth-building journey? Are they proactive or reactive? Do they challenge you to think bigger or keep you comfortable? If you're early in your journey, you might not need a full team yet, but you should know what positions you'll eventually fill. Start building relationships with quality professionals now. even if you can't afford their services yet. Many successful people are willing to provide guidance to ambitious individuals who remind them of their younger selves. Attend networking events, join online communities, and actively build your network. Your net worth is often directly tied to your network. Invest in relationships that will support your wealth-building journey for decades to come. The Billionaire Mindset. The Frasers conclude with perhaps the most important element: mindset and action. You can know every strategy in this book, but without taking action, nothing changes. Billionaires distinguish themselves not just by what they know, but by their willingness to act decisively. The billionaire mindset starts with abundance thinking. Most people operate from scarcity, believing wealth is finite and someone else's gain is their loss. Billionaires see abundance, understanding that wealth is created, not just redistributed. This mindset shift is foundational because scarcity thinking makes you fearful, envious, and risk-averse. Abundance thinking makes you collaborative, opportunistic, and action-oriented. Billionaires think long-term. They're willing to delay gratification, make sacrifices today for payoffs tomorrow, and stay patient during the compounding process. Average investors panic during market downturns. Billionaire investors see buying opportunities. Average people want quick returns. Billionaires think in decades. Billionaires take ownership. They don't blame the economy, the government, their background, or their circumstances. They take full responsibility for their financial outcomes. This ownership mindset is empowering because if your results are your responsibility, then you have the power to change them. The Frasers emphasize that billionaires are action-oriented despite uncertainty. They don't wait for perfect information or guaranteed outcomes. They gather sufficient information, assess risk, and move forward. They understand that inaction is often the biggest risk. Opportunities have expiration dates. The perfect investment you're analyzing will be gone while you're still researching. Starting is more important than perfection. Your first rental property won't be perfect. Your first business won't be optimal. Your first alternative investment won't be your best. But each step builds knowledge, confidence, and momentum. Billionaires weren't born billionaires. They started small and scaled over time. The Frasers also discuss the importance of resilience. Every billionaire has faced failures, losses, and setbacks. What separates them is they didn't quit. They learned, adjusted, and tried again. Financial failure isn't permanent unless you let it be. The most successful investors often have the longest lists of failures because they've taken the most swings. The practical call to action: stops consuming information and start implementing. Choose one strategy from this video and commit to taking action within the next 30 days. Maybe it's researching a private real estate syndication. Maybe it's starting a side business to generate additional income. Maybe it's meeting with a tax strategist to audit your tax efficiency. Maybe it's reading 3 books on alternative investing. Small actions compound into massive results over time. You don't need to transform your entire financial life overnight. You need to start moving in the right direction consistently. Think like a billionaire: abundance over scarcity, long-term over short-term, ownership over blame, action over analysis paralysis. Your wealth-building journey starts with the decision to start. Make that decision today. Investing like a billionaire isn't about having billions. It's about adopting the strategies, thinking, and behaviors that create billions. The Frasers have given us the blueprint. Shift away from public market dependence toward alternative investments. Embrace direct ownership of businesses and real estate. Use the tax code strategically to build wealth faster. Manage risk intelligently through diversification and protection. Commit to continuous financial education. Build a team of experts to support your journey. And most importantly, take action with a billionaire mindset focused on abundance, long-term thinking, and personal responsibility. The wealth gap between billionaires and everyone else isn't primarily about luck or inheritance. It's about access to information and willingness to act on it. You now have the information. The question is whether you'll act on it. Will you keep investing the way Wall Street tells you to? Or will you start investing the way billionaires actually do? The path to significant wealth is clearer than you might think. It requires education, strategy, discipline, and time. The billionaires of tomorrow are taking action today. They're learning about alternatives, building businesses, buying real estate, optimizing taxes, and thinking decades ahead while their peers chase short-term gains in traditional markets. Your financial future is being created by the decisions you make right now. Choose to invest like a billionaire and watch how your wealth trajectory changes. Thanks for watching. And here's to your journey toward financial independence and generational wealth.